The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Inflationary pressures ease, AI enthusiasm swells, stocks back towards the record high. Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine. I almost forgot how to start this show. I'm Romaine Boston.
I'm here. And I'm Isabel Lee. It's finally Thursday. We're almost at the weekend, Romaine, and we're kicking you off to the closing bell here in the U.S. And this is where we stand. We got more inflation print today, Romaine, and it really showed that inflation is moderating, which means that the Fed will probably refrain from raising interest rates next month. You're seeing an S&P that's seeing back-to-back gains up near record highs, up by around 0.6%. The Nasdaq, of course, is up higher by nearly 1.5%. I want to bring your attention to the U.S. 30-year yield. It's now hovering at 5.2. About an hour ago, the U.S. sold 30-year bonds at the highest rate since 2001. This is a testament to investor demand for compensation when it comes to the nation's fiscal deficit. And of course, it's going to be a headache for President Donald Trump and U.S. Secretary Scott Bessent. And now we're looking at crude oil. It's around $86 a barrel, down by 2.5%, Romaine.
Back to the top of that screen with the record high for the S&P 500. In fact, today could be a record high for both large cap and small cap benchmarks alike. An encouraging sign that Wall Street's near unwavering bullishness. Maybe it wasn't misplaced. Two benign inflation reports this week, a solid earnings season providing proof of life for extending this bull market. In fact, 7 months ago, strategists were anticipating earnings for the S&P 500 companies as a whole of $306 a share this year. As of last month, that averaged up to $332. And today, Scott Croner and his team over at Citi bumping their forecast to $365, among the highest among strategists tracked by Bloomberg. In fact, when you take a look at the second quarter earnings season, it's shaping up to be one of the best 3-month periods in quite some time. Profit growth running more than 30%. Bank of America strategists, they expect growth to remain above 20% for the rest of the year. That would be a 4-quarter streak above 20%, a streak that's occurred only 10 times since 1936. The not-so-secret sauce keeping things going, AI. From the revenue boost from AI spending to the EPS boost from productivity gains for the companies that are adopting it.
Every company I talk with has got 12 to 15 use cases on AI adoption and is optimistic that they're going to find ways to improve margins, improve their business, improve productivity. And so I think the S&P broad earnings story is alive and well for not just this year, but into the future.
Chip equipment company Applied Materials set to report after the close. Analysts seeing strong prospects. The company will signal sustained demand going forward. Maybe we got a little preview of that just a few hours ago with Sandisk, the flash memory maker, the best performing stock out there this year, holding an investor day right here in NYC and saying it expects its revenue to grow at a mid to high teens rate through at least 2030. And get this, Isabel, gross margin going to sustain itself at 80%.
That is really shocking numbers, Romaine. It seems like the AI craze is still continuing. It shows no signs of stopping down. And I want to talk about AI still because there's nothing to talk about. And let's take a look at this chart. This chart is really, for me, it struck me because the white line, you see, it's the Bank of America's Momentum Index. And you see the blue line, that is the one that tracks the long-term earnings growth expectations. So as you can see, both are rebounding over here. But look at how sharply momentum has snapped back. That's really the question for the AI trade. Can earnings growth justify the renewed rally? And you see prices cracked first and hard earlier this quarter, while long-term growth expectations held up much better. So now both are rising again. So this suggests perhaps that fundamentals may be starting up to catch up with momentum, Romaine.
Absolutely. That momentum maybe catching up with earnings catching up with the momentum. Well, take your pick. Darrell Cronk joins us right now, CIO of Wealth and Investment at Wells Fargo and president of Wells Fargo Investment Institute. And that's where I want to start with you, Darrell. Your thoughts here right now on the AI trade. Is this one of those things that you ride out, that you buy into, that you add when you see those dips?
Yeah, I think you definitely have to add when you see the dips. I mean, in the very short term, since the July 29th bottom, tech as a sector is up about 12 to 13%, which is just a white hot move. So I think you've got to have a little bit of a dip, a little bit of the momentum trade coming back off the boil. I mean, just at the broad index level, Romaine, the S&P today is about 11% above its 200-day moving average. That puts it usually in historically overbought conditions in the very near term. So it wouldn't surprise me as we get out into September and October that you see a little bit of, profit taking, repositioning, some of that profit pushing prices back down. But I would use that as a buying opportunity.
Yeah, and I mean, certainly, and you look at some of the technical indicators like the RSI on the S&P approaching that 70 mark, considered to be overbought. Yep. But, I guess the question, and it's really something that a lot of people have raised, is that you can look at those metrics and say things are overbought, but then you look at, these income statements for some of these companies and, well, they're over-earning.
Yeah, I know, 100%. And I think, look, I won't drain the conversation about AI because everybody talks about it. I think the most important and relevant things from Q2 were, number one, not the bottom line 30% earnings growth, but the top line 15% revenue growth across the index. That's unheard of, number one. Number two, you've got a broadening of those that earnings. So you have 10 of the 11 sectors now in positive territory for earnings growth, and 8 of those are in double-digit earnings growth. And then people forget to talk about all the benefit to margin and earnings that came through the one big beautiful bill of all the deductibility of that CapEx spend, manufacturing structures, equipment, all that stuff. So if you're getting AI driving the top line growth, but you're getting the benefit in margin and earnings through the one big beautiful bill tax deductions, that's just a recipe for double-digit earnings growth for quarters to come.
Darrell, you're bullish on equities, but you're also telling clients to rebalance. How do you square those two views together?
Yeah, I think you've got to be a little selective in where you have your exposure, Isabel. Certainly we like tech and have liked tech for quite a long time. It's been an overweight in our portfolios. But I think you can also look at tech-adjacent places like utilities, which have been beaten up, we think are attractive, like materials, which have underperformed, which are going to benefit on not just the AI build, the semiconductors, the hyperscalers, the data warehouses, but really that next wave of AI, which is all about the integration and monetization of AI. That's where you're going to start getting some of the benefit. And then we actually think financials continue to do well here. You know the story about healthy balance sheets, strong loan growth, M&A activity picking up, all kinds of favorable things for financials. So we think they look attractive here too, Isabel.
And oil is becoming increasingly important for the long end of the Treasury curve. So if the crude moves towards your $85 year-end target, do you think that makes the Fed's job harder?
It definitely will make their job harder. Look, I think we're building a more permanent premium, you could call it geopolitical premium, into the price of oil. I know the supply-demand dynamics, if you could somehow open the strait back up and bring everything back to what was the old normal, but I'm not sure the old normal is the new normal anymore. And so I think you've got to think of oil as being 80, 85, maybe even $90 a barrel. If that's the case, it's going to keep pushing inflation pressures. I know we're all happy about the CPI and PPI prints this week, but remember we have one more full set of inflation data in August to see before the Fed has its September meeting and makes a decision on interest rates.
With all the focus, Darrell, right now on the AI trade, and obviously it is a big driver of the markets and the economy, we'd be remiss in not pointing out our economy, and to a certain extent the market is still driven by the consumer. When you take a look at the economic landscape right now, do you have confidence that that consumer is still going to come through for us in the rest of the year?
Well, it's interesting because you can almost flip the script here, Romaine, and say, the consumer under the surface, when you look at, whether it's credit cards, auto loans, delinquencies, defaults, spending habits, all looks fairly healthy. I wouldn't call it crazy robust, but looks fairly healthy. So the consumer as a whole, we think, is okay and will continue to be okay through the remainder of this year. What's interesting is we've been underweight or unfavorable the consumer segments of the market. So think staples, discretionary, which have materially underperformed the broad index because that pricing power is getting ever more difficult to push through in corporate America in the consumer space. So I think it's a little bit of a tale of two halves. The actual consumer is doing okay. I would not want to have a plethora of exposure in my portfolio, though, to consumer, staple, or discretionary names in my investment portfolio.
All right, Darrell, always a pleasure. Darrell Cronk, CIO of Wealth and Investment over at Wells Fargo, kicking us off to the close. And speaking of the consumer, a lot of mall operators rallying for yet another week. Are there signs out there that maybe that pullback in inflation fueling a comeback for the consumer, and specifically a comeback for mall real estate? We're going to catch up with Naveen Jaggi, president of Retail Advisory Services over at JLL.
Plus, from food court to the basketball court, we'll unpack the record-breaking deal of Bob Iger and Josh Kushner for the LA Lakers with Bobby Sharma, founder and managing partner at Bluestone Equity Partners.
Absolutely, and we're going to talk about what's been going on in the world of private assets and the world of insurance and tracking the explosion of fund finance. Anant, Bhalla, CEO of 1823 Partners, and the relatively new CIO and global head of insurance at JAB. He's going to be stopping by the program as well for an exclusive conversation. All that and more coming up in a bit, right here on The Close, right here on Bloomberg.
This week's inflation data signaling easing price pressures on consumers and manufacturers. Our next guest suggests that's pushing the pendulum back into positive territory for retailers. Joining us live is Naveen Jaggi, president of Retail Advisory Services at JLL. Naveen, thank you for joining us. We know that retail demand bounced back sharply in Q2. I mean, we know that mall maxing is becoming a thing among younger generations. In fact, I grew up going to the mall with my mom a lot. Is that a sign that the consumer is healthier than perhaps what the sentiment surveys we're seeing suggests?
Yeah, I think at the end of the day, if we're talking about the mall as an example, the mall is back. We've gone through about 10 years now of closing down roughly 500 malls across America, which means that the remaining malls that are still standing for the most part are the ones that are well performed. And I think you'll see the investors that are investing in those malls know what they're getting back, which is a quality environment to go shopping in. So who would have thought that in 2026, we're talking about the mall rats being back, but that 1980s term probably is more salient to then it's been in a long time.
That's a new term for me, mall rats. So if spending is rising faster than inflation, though, where is that money coming from? I mean, are households feeling better, or maybe you're seeing some households prioritizing retail over other expenses?
Yeah, I think the households, for the most part, if you take a look at one example, which is back-to-school shopping, we saw back-to-school shopping results say very bullish that they'll spend more than 10% up from last year. But I think what we're also seeing is that the consumers are being much more careful about what they're buying themselves. It used to be in the past that when you'd go out shopping, like you do during the holidays, that you would shop a little bit for your family and shop for yourself as much. Not as much in this particular survey. We heard most consumers say they're going to get the basic needs, the basic necessities for their families and their kids, and they may not buy themselves the stuff that they're used to buying, that aspirational shopping that we're so used to seeing in the past. We're hearing a little more pullback on that. And I think that tells us that with credit card debt the way it is right now, as an example, consumers are feeling energy pricing, housing pricing, rent pricing pressures are putting more pressure on their discretionary spend. So for right now, Walmarts and Costco's of the world are doing a great job of getting that customer as his target. But I think that aspirational retailer, they'll be feeling that pain in the back-to-school shopping. I think they'll get that consumer back during the holidays.
Well, I am curious about it. We're going to hear from a couple of those companies that you mentioned, I believe Walmart and Target report next week. But when we talk about this kind of trading down thing, there's a lot of questions as to whether this might actually be a little bit more structural rather than just, people are tightening their belts and they're looking to actually save a little bit money. Are you seeing any sort of longer term trends at this sort of search for value by the consumer in the retail space that is sticky?
Yeah, Romain, I think that shift towards kind of daily value shopping, that kind of got entrenched into our economy back in the post-Great Financial Crisis days of 2008, 9, and 10. Consumers today are smart. They know where they want to get what they want to get when they want to get it. So on an average daily basis, they will downshift and go to the best place to get the most for their dollar. During our survey, we found that most consumers were going to spend money, but they wanted more products in their basket for the same $100 spend. That's something we didn't hear as much last year. So I think you're right, Romain. We are seeing this continuation of getting the most for your dollar. But right now, with the energy prices at the highest level we've seen in quite a few years, you're going to see more and more of that pressure on the consumer to say, where do I get the most every time I go shopping? Whether it's the grocery store or whether it's the department store, I'm going to make that dollar or that $100 go as far as possible.
Talk to me about just the other side of this equation, and that is for the property owners and landlords out there right now. I know we've talked in the past on this show about some of the supply constraints out there that are acting as a tailwind here. Is the setup still going forward over the next few years? Is that still relatively favorable?
Yeah, I believe that other than a few markets that we've seen construction going up due to demand, where the cost of construction and the labor is available, Texas, Florida, Georgia in particular, we're not going to see the kind of construction that we need to really meet the demand at a national level. So as long as we don't have the construction that we had back in 2004 up to 2015, 16, and 17, we're likely to still see rent going up. And so the owners that own these properties, the very best malls in America and the best shopping centers in America, open air and closed, they're going to continue to see rent rises. And I think we saw no better example of that when we saw Bed Bath & Beyond close en masse a couple of years ago. You took the average owner had said that his rent on that space, that prime A space, doubled when you took the Bed Bath & Beyond and gave it to another retailer. That's significant rent pressures. And when you take that across an entire portfolio, that's a positive sign for what we're going to see from those owners in 27, 28.
I'm glad you brought up rent because they are rising and growth is slowing. So then is that normalization, or do you think that maybe that's a sign that retailers may be hitting a ceiling?
I wouldn't say retailers are hitting a ceiling. Retailers have got to continue to grow. I think what retailers are doing is they're being better and smarter and knowing how to inventory their stores. You know, we've talked a lot about AI over the last couple of years, especially in the last 6 months. Even retailers have gotten smarter about how to inventory their stores using real data as a way to drive store inventory to match what their consumers need. So not just depth of inventory, but the breadth of the inventory and the supply and the quality of the inventory. So I think it's not a ceiling, it's just creativity. Retailers know exactly what the consumers want, and they're getting smarter about how to give it to them when they want it.
Naveen, always a pleasure. Naveen Jaggi, President of Retail Advisory Services at JLL. And we're going to stay in the retail space when we come back and take a closer look at Tapestry. The shares having their worst day in about a year on the back of a, well, was it actually a bad earnings report? We're going to catch up with an analyst who covers it when we come back after the break. This is Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. And we start off with Vail Resorts, an initiation of coverage over at Goldman Sachs on the ski resort operator. It's a sell rating, a 132 price target. The analyst, Lizzie Dove, saying Vail's Epic Pass membership has already captured a significant portion of the addressable core skier base, and pricing power is starting to hit a ceiling. Those shares down 1% on the day. Next up, StubHub, Bank of America downgrading to underperform after the ticket company missed earnings estimates last quarter. The firm slashing its price target to $7.50, citing slower growth ahead as the boost from the World Cup fades. Those shares having their worst day since February. And lastly, Five Below. Jefferies upgrading the discount retailer to buy as they see the company transforming from a trend-driven retailer into a durable growth story. The firm boosting its price target to a street high $350 a share. The shares today, right now at $243, but at one point traded above their $248 all-time high. Those are some of our top calls, and we do want to stay in the retail space right now and check out a stock going in the opposite direction. Tapestry, down the most in a year. This after the maker of Coach and Kate Spade reported a full-year forecast that did miss analyst estimates. Joining us right now to talk a little bit more about this is Adrienne, a managing director and senior retail analyst over at Barclays. She's got an overweight on Tapestry with the 182 target. Are you surprised by this reaction? Because, I mean, we go through the numbers. The growth was there. It was phenomenal. Double-digit growth. Still a story that is almost entirely about Coach rather than Kate Spade. There was growth on the bottom line as well. But the guidance they gave going forward seemed to suggest some sort of deceleration. Is that what the market is reacting to?
That's exactly what the market's reacting to. And remember, they have a very odd year end. So they have a June year end, and they have to give FY27 guidance, so on the 12-month horizon from here. They have just had an analyst day back in September, so not long ago. And over the course of the past, 4 to 5 quarters, the company has effectively made their 3-year long-range plan in the first, 15 months of that 3-year plan. So I think it's kind of what, I think you've heard me talk about retail pole vaulting, which is basically the better a company does, the higher we raise the bar for them. And I think you really have to believe at this level, that from this level, that Tapestry is going on to 25% operating margins, right, where they're sitting at 22% today. So we believe that that's the case, but every once in a while, you need a stock to consolidate. And so we were very much in a momentum stock, environment for the past, call it, 3 quarters. And I think on these types of data points, again, it's the guide, right? Not the actual, but it's the guide that's kind of showing that deceleration.
Well, this gets to this idea, too, and we go through the numbers. When you talk about the 25% operating margin, obviously, you look at the SG&A, you look at the marketing expense, it all looks favorable. But there's a trend story here, and we've talked about this in the past, the resurgence of Coach, and the idea that they're coming off of these quarters of phenomenal growth there. And how do you keep this going in an industry, let's face it, that it can be very fickle when it comes to fashion trends?
Yeah. So here's the key number, right? We're not going to look at sales, we can look at margin, we can look at all the different operating margins. Those are all outputs of what the company puts in. And the input, the secret here for any retailer, frankly, is new customer acquisition, right? The lifeblood of future growth, future sales, future demand is what you're doing today to bring those customers into the corral. right? And so I just want to give people numbers. In the past quarter, year on year, they acquired 2.5 million new customers. A third of them were in that Gen Z cohort. And over the past year, they've acquired 11 million new customers in that same, with a third of them in that cohort. There are no other companies, right? Not even Ralph Lauren at this point to this day is acquiring new customers as quickly as Tapestry is, as Coach's.
So indeed, Coach is up 14%, Kate Spade is down 7%, and you gave a couple of examples there. Talk to us about the divergence of the consumer, especially the younger consumer, and where they're willing to spend. Is this story a Coach-specific story, or are they just spending where they see more value?
So that's a very interesting question, because what we're seeing, lack of price resistance, right, is actually where they see kind of branded value. So what's interesting is they're not looking for discounts at Coach. They are pulling back on promos. They're selling at full price. They're actually raising prices and mixing in higher product. But the core of the business is $200 to $500, sort of that sweet spot. So what I would say here is what we see in Kate Spade is just lack of kind of brand authority, right? So Kate Spade over the past decade has had a couple of reincarnations. None of them have been very successful. And I think really what you see with Coach, so the story with Tapestry is you are investing in Coach with a call option on Kate Spade.
A call option on Kate Spade. Is that going to be the same playbook that they use with regards to getting Coach up there, or does it need to be something materially different?
So it's exactly the same playbook, which is to pull back on inventory, improve your points of distribution, focus on R&D. And then the key here, right, is that they've taken marketing dollars and they've actually used data. They have one of the greatest data lakes of any of the retailers that is out there. Tomorrow they're doing a big AI presentation for the street. So they're really focused on, and I think a lot of times we underestimate and we forget how much is creative, but there's also a very data-driven part to this. And so they are doing the same thing with looking at the returns on ad spend, and it'll take time. I will say, historically, Coach has just been a stronger, longer, brand. It's been around for 85 years. So I do think Kate will turn. I think it's going to take longer.
Adrienne, always a pleasure, always smart. Adrienne Yee, we'll talk soon, Managing Director, Senior Retail Analyst over at Barclays. All right, coming up, we're going to talk about that blockbuster deal that we learned about yesterday for the Los Angeles Lakers NBA team. Former Disney CEO Bob Iger teaming up with Jared Kushner's firm for a record-breaking deal. We're going to talk to Bobby Sharma, founder and managing partner at Bluestone Equity, when we come back after the break. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Isabel Lee.
I was keeping an eye on some of the few publicly traded sports-related stocks, like Madison Square Garden. The Atlanta Braves have a publicly traded stock as well. They all got pretty strong bids yesterday. They're getting another bid today, and this is all on the back of that news that broke about the Los Angeles Lakers out there being sold for $12 billion. That's a record for a U.S. sports franchise.
It's honestly so shocking. And for me, what struck me the most is the lack of bankers, because in my head, I thought, what are we going to do? I mean, they're usually crucial to a deal, and reports said that this was done in a day. So that's really a new thing for me and for the world. Maybe we will lose our jobs one day, and bankers will lose their jobs one day.
I think the bankers will be okay. Bankers and lawyers. That's what I tell my son. We have to be okay, just stick there and you'll be all right. But our next guest, he's got a lot to say about this. He knows a lot about this. And he says this next deal, it actually speaks to the institutionalization of sports as an asset class and the scarcity premium being placed on these big teams. And he would know. He spent nearly a decade with the NBA Development League. He worked on franchise administration, team ownership, corporate transactions, and sponsorships. Now he's got his own fund, and he's doing well. Bobby Sharma joins us right now, founder and managing partner at Bluestone Equity Partners, which I should point out, invests in sports, but not necessarily taking stakes in teams.
We look at teams. Teams
would you have bought into the Lakers if you had been given the opportunity?
Well, that's the subject of the day.
Okay.
Well, I think there are probably two stories going on here. One is the price, which is obviously an extraordinary valuation at $12.5 billion. And the other is this institutionalization of sport. The Lakers themselves are a special asset within that ecosystem. I had the good fortune of working very closely with them when they were the very first team, NBA team, to purchase an NBA Development League team, minor league team. Mm-hmm. And they have long stopped being just a basketball team, right? Long stopped being just a community asset. it is extraordinarily valuable, globally relevant IP. And for that, there's certainly a scarcity factor, but scarcity does not remove price discipline. And a great investment doesn't necessarily mean it's a great investment at any price. At the end of the day, the $12.5 billion being put to work here is going to have to return an appropriate risk-adjusted return.
Well, when we talk about price discovery, or maybe the lack thereof, how do you arrive? If there was no sort of traditional price discovery, how would you even arrive at $12 billion? It's basically just either whatever the Lakers ownership decided, whatever Mark Walter decided was worth, or what Joshua Kushner and Bob Iger decided that they thought it was worth.
Yeah, I don't think you can answer that question without knowing the underwriting of the buyer.
Yeah.
There have been 2 precedent transactions here within 10 months, 25% premium on that headline price. But without knowing the underwriting, without knowing the time horizon, it's hard to say. But ultimately, as I said, well, as you said, actually, from our prior conversation, there's price discovery going on here, right? And that's distinct from value creation. So I wouldn't necessarily impute a 25% premium on every NBA team. In fact, if anything, I think there might be more price dispersion with the truly elite global IP-oriented teams commanding a premium, where other teams still having to justify their economics.
But I just want to link back, because you talk about the global IP and how this is more than just a community asset. And you can say that for, obviously, a lot of sports teams, not just in the NBA, but particularly in football, as well as a few others. And it gets to this idea that with this institutionalization of this asset, of sports as an asset, isn't that kind of almost necessary if this has become more than just that, local community asset?
Yeah, I think, if you look at the multiple expansion amongst the sports teams that are being sold, the NBA and WNBA teams are actually nearly twice that of Major League Baseball. So Major League Baseball is still figuring out its fundamental economics as they're about to enter labor negotiations, or they've actually just begun that. That could be very disruptive, significant, all towards the end of creating an economic system that makes sense for it. I think the NBA has long figured that out. They've had labor peace. They've just a year ago concluded a $76 billion 11-year media deal, which is that visibility to those kind of economics, or part of that value driving in terms of the scale of these assets, increasing from where the Buses bought them or the Steinbrenners bought the New York Yankees to where we are today. But ultimately, these teams trade on the fundamentals, apart from what I would offer to be the truly elite, globally and culturally relevant IP, like the Lakers, where there is a scarcity premium being put onto the pricing. And again, without knowing the motivation, without understanding the underwriting and time horizon of the buyers here, I should say, and Mr. Iger and Mr. Kushner, it's hard for us to speculate.
So nuances aside, I want to go back to Romein's point of the price tag, the $12.5 billion. What has to go right for this to look cheap, maybe 5 or 10 years from now, or maybe a good deal?
Yeah, I think a 20, 30-year hold, for instance, if that's the intention here, as an example, is something that might compute. There's tremendous optionality value. There's a tremendous growth potential over that kind of a horizon. So it really just depends on what the underwriting is for the buyer.
So, I started off talking about how you invest kind of in sports, but not necessarily in teams. Are you interested in actually, we're institutionalized now. You're an institution, more or less. Are you interested in doing something? Are you actively looking for something right now?
So we've looked at roughly, this number keeps climbing. I think last time I was here it was smaller, but I think we're roughly at 1,800 deals that we've looked at, 72% proprietary. We have tremendous high quality, high volume deal flow. We look at teams, but we underwrite to very specific returns. So as the asset class, as the industry of sports media and entertainment continues to grow and institutionalize and professionalize, the ecosystem around it continues to institutionalize and professionalize. So we don't compete for trophy assets. We don't bid up pricing. We're not part of the price discovery for elite NBA teams. But what we do is look for businesses that are benefiting from those secular tailwinds.
But then what are you looking for in terms of actual revenue metrics? Because I mean, you use the word trophy assets, and I just want to push back. I feel like we're kind of moving away from that. It was like, somebody made their money in another industry, and they wanted to, live out their days in glory, and you bought a sports team. And now, with all the institutions there, I mean, somebody's got to be sitting there with a spreadsheet or the equivalent of that, doing, discounted cash flow. I don't know if that works for a team like the Lakers, but I assume you're doing that, right? You're looking at what the revenue streams are. What's most important to you where it would present a good value opportunity?
Well, back to the other question about what has to go right. So they are locked in for their primary revenue driver, meaning the media deal, for 10 more years, right? So that's baked in. And the $12.5 billion price would have had to have priced that in. International is a massive opportunity for basketball. I'm sure that's maybe part of the underwrite here. I'm sure maybe, but that's likely part of the underwrite. NBA Europe, you're hearing a lot about, and the NBA is looking to expand and create value by creating assets there. We're living in an increasingly focused on live experiences world, and I think if you look at the buyers, it's almost as interesting as the purchase price. So in Bob Iger, in Josh Kushner, you have an incredible amount of experience in terms of globally relevant IP, entertainment, sports, media, distribution, technology. Full stop there. On Kushner, you've got an extraordinary investor, technology-focused, growth-oriented, long-term, durable capital. The two of them together, pivoting from what was an NBA expansion opportunity they were looking at in Las Vegas to this, and paying that scarcity premium, which again I offer, is attributed more to the Lakers having 17 world championships and being relevant on every continent on the planet in terms of its value creation opportunities.
Right.
But they're pivoting to this at that kind of a premium, a 25% headline premium, I think is indicative of where sports investors see sports as an asset class headed.
Well, let's take out the 17-time champions for a second. I mean, are you finding potential opportunities maybe outside of just the gigantic mega sports and the mega teams? I mean, we had Karen Nortman on yesterday. She just kind of invested in an expansion NBA franchise at a record $200+ million. She was also involved in a women's soccer league, National Women's Soccer League expansion franchise, which was also over $200 million. Is that more sort of the secondary sports, for forgive my phrasing? Is that where the growth is really, or maybe the value proposition?
No, we at Bluestone tend to steer away from that in the sense that there's a lot of, apart from like the really durable, established sports properties, there's a lot of emerging properties, there are a lot of venture-oriented businesses in that economy as it institutionalizes and professionalizes. But where we have a hard time investing is where the valuations tend to get ahead of the cash flows. So ultimately, we're not speculative investors. We focus on fundamentals like cash flows, like quantifiable, fully diligenced growth. And we have made 10 investments in about 40 months, representing about $300 million of our $350 million Fund 1.
All right, Bobby, got to leave it there. Great to have you. Bobby Sharma, founder, managing partner over at Bluestone Equity Partners. We'll be back in a moment. This is Bloomberg. Our stock of the hour is Workday, having its biggest intraday jump since 2012 on the back of a report that private equity firm Silver Lake is in talks to purchase a software provider. Carmen Reinecke joins us right now, helps to lead our stocks coverage. What do we know about this? This is based on a Reuters report right now.
Yes, exactly. So what we know is that there have been talks to potentially take over Workday. This would be one of the largest software buyouts in history if it goes through. For what we know, according to people familiar with the matter, as Reuters cited, is that their talks are ongoing and there's no guarantee that there would be a deal here. But as you said, we're seeing a really significant jump in the shares. They spiked as much as 30%. They're on track to close up 17, 18%, which would be the best since 2016. And we've seen software companies really be hit this year with fears of AI sort of eating their business models, the SaaS apocalypse that we've heard of. So it seems like this is some there's some potential hope here around M&A.
And definitely a lot of superlatives. Talk to us about the ongoing battle between software, hardware, and how this trend is playing out. We have around 30 seconds here.
Yeah, so we've just seen investors really sell off software because of the SaaSpocalypse fears that they don't know how AI is going to actually be beneficial to this industry. And on the flip side, we see chips really rallying, especially certain parts of the AI infrastructure trade, like memory. You know, we have Sandisk up today after an investor day. There's strength in other parts of the trade there. So this is interesting because there could potentially be more M&A in the software space. A lot of these companies have gotten pretty beaten down, especially the ones that were already on the smaller side. So it's something we're definitely going to be watching here as this continues to unfold.
Yeah, when you look at some of the valuations, I guess if you believe in the long-term story of software and the transformation, some of these valuations kind of attractive. Carmen, great to have you. Carmen Reinecke over at Bloomberg News. A closer look at Workday. The share is now up 17%, dragging up some of the other names in the software space as well as we move closer to those closing bells. A closing bell that is set to log the S&P and the Russell 2000 at a record high. We'll be back in a second with Mike Contopoulos over at Janus Henderson. Stick with us. This is Bloomberg. Breaking news for those of our viewers in New York City. We just actually learned that Mayor Zohran's Mandami pied-à-terre tax can actually proceed for now. An appeals court temporarily putting a hold on other judge's order that actually blocked the plan. So good news for you, Isabel, with that $10 million second apartment that you have.
I was going to say that I've kind of been checked out with this news because I'm like, I don't have a second home. I don't even have a first home. We are renters.
Yeah.
Anyway.
Well, obviously anything that's stirred up obviously a lot of controversy here in New York City, at least for right now. Yeah. It's back on, but of course, ultimately, as I just told you a few minutes ago, the lawyers always decide. Let's check on the markets, Isabel.
We're seeing back-to-back gains in S&P 500, so we're seeing the stock hurl themselves towards a record higher by around 0.6%. You're seeing the Nasdaq, of course, higher, even more by 1.2%. The big story today is the 30-year bond. It was sold at the highest rate in a quarter of a century. That's 2001, Romaine. So don't worry, I was born then. And you're seeing oil there, $86 a barrel, down by 2.5%.
Yeah, 5.214 right now on that 30-year yield in the secondary market. Mike Contopoulos joins us right now, head of multi-asset macro investing over at Janus Henderson Investors. Not to age you, but I'm pretty sure you were around as well back in 2001. But it gets to this idea, are we making too much of this? I mean, on one hand, it seems like it's kind of a little bit of a headache for the Treasury Department if this is the trend line where investors are going to continue to demand more compensation, particularly for longer dated bonds.
I wouldn't know if we're making too much of a big deal about it. I mean, these have real-life consequences. Obviously, the amount of interest the government's paying on its debt continues to go up. It's going to affect how the government finances itself going forward. You'll see probably more bills issuance, more short-term issuance, which then creates refunding risk in the future. So there are consequences. But what I think we saw today is that there is still demand for long-duration U.S. government debt. I mean, this wasn't an A+ auction by any stretch of the imagination. It was probably closer to like a B or B- auction, but there was demand. And I think that what I learned today was that investors north of 5% still want U.S. government debt to some degree. Now, whether that will be a good decision ultimately, we'll find out. And it certainly isn't good for the Treasury and sort of the fiscal position of the United States of America, but there is demand there.
But what's the message, though, in totality coming out of the bond market with regards to the U.S. fiscal situation, and more importantly, the U.S. inflation situation and economic situation? Because it does seem there is a lot of discomfort right now about where we stand with inflation, whether it's persistent, whether we're actually going to be successful in fighting it. Where do we stand?
Yeah, I think there's a lot of concern. I don't know if there's enough concern quite yet. I think the big joke amongst our team in the macro investing is not so much of a joke, I suppose. It's what comes first, $5 gasoline or 5%, 10-year treasuries. And I think maybe one follows the other to some degree. But, I do think that there is a lot of risk to the treasury market, not because of any one particular auction or one particular data point, but because of secular headwinds to inflation that I don't know are fully internalized by the market yet. You have significantly changing demographics. You have a changing geopolitical world with deglobalization versus globalization. All of that is going to continue to press inflation upward. And this idea that rates are going to fall 70% of the time for the next 40 years, which is what they did between 1980 and 2020 is probably just the wrong assumption going forward. And I would think 60, 70, 80% of the time we're going to see a higher rate environment rather than a lower rate environment. And I'm not entirely sure investors have fully grasped onto that yet. And that's going to be driven by inflation as well as fiscal concerns.
You did say that investors are a little complacent when it comes to the Fed and inflation, but I want to go to stocks. I mean, earnings are great. The economy is doing fine. So why shouldn't investors be bullish on equities? And you're one of our few guests, actually, who isn't like rah, go stocks.
Yeah, so we don't mind stocks here. We're actually overweight equities in our multi-asset portfolios. So we think we're later cycle. Later cycle can last for some time. But for now, we are overweight equities. I think where we're a little bit more hesitant is perhaps around the speculation in the market that we see, and sort of the more speculative areas in the market, the more concentrated areas in the market, the high valuation, high PE, high multiple areas of the market, which makes those areas of the market long duration and very sensitive to interest rates. Those are the areas of the equity market where we're a little bit more cautious, but we're actually quite bullish on the rest of the market. And we think you're going to see more broadening both within U.S. equity markets as well as global equity markets as earnings growth sort of propagates across a wider swath of companies. So I wouldn't necessarily say, again, that we're not constructive in equities. What I'd say is we're maybe a little bit more constructive on equities where everybody else isn't constructive.
In your note, you did write that long duration equities with rates still elevated. You are warning about that. But how vulnerable are the big AI winners if the Fed continues to stay hawkish?
I think they're very vulnerable. When we hear about long duration, everybody naturally goes to the fixed income market. But in equities, you have long duration assets as well, and long duration equities. High multiple companies are long duration. Versus, say, a value company or a dividend payer. Dividend payer, by definition, is a low duration company. So we prefer sort of more lower duration, higher dividend paying companies to higher growth companies. And many of the higher growth companies live in that AI space. And I think what we're seeing there is not that the AI story isn't real, that it doesn't have economic consequences, or is not a real sort of change in how we think about the world, how we act, how we'll work, et cetera. But as an investment story, there's no lack of capital in artificial intelligence companies. And you want to be where capital is scarce, not where it's most plentiful as an investor. And that concerns us.
As we get deeper into this year, there was a lot of talk coming into this year about the outperformance, or at least the sort of matching of performance by non-U.S. assets with U.S. assets. And that's still relatively held up, a couple of percentage points quibbling difference here. Do you think that we're going to see a little bit more of an international embrace? Not saying people are fleeing the U.S., but the idea that there will be more international diversification.
I absolutely think so.
Yeah.
So, there's by many studies, about 8% of private client portfolios are in international equities. 8%. And when you think about that, the All Country World Index is about 35% international equities. So there's a massive underweight to international. Think about that comment I made earlier. You want to be where capital is scarce, not where it's most plentiful. You have huge capital scarcity in international markets, and the earnings growth in international markets is accelerating. It's not decelerating, while central banks arguably can be easier in international markets than maybe in the U.S. So that's sort of like the trifecta. You have strong valuations, potentially easier liquidity, accelerating earnings growth, coupled with a scarcity of capital. That paints a really, really good picture for international equities.
Mike, always great to have you. Got to leave it there. Michael Contopoulos, head of multi-asset macro investing at Janus Henderson Investors, counting us down to the closing bells, Isabel, with the S&P right now camped out right around that 7,800 level. Looks like that is going to be a record high if this holds.
It's definitely going to be a record high. And again, we still continue investors pile capital into a lot of risky assets. So there really is no signs of slowing down. And optimism, Romaine, is still quite frothy.
We are going to get some earnings after the bell tonight, included from Applied Materials. Our coverage starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Isabel Lee. Taking you through to that closing bell is a global simulcast. We're joined now by Carol Masser. And there's also Tim Stenovic. So we welcome our audiences
always
across
sound
all
surprised.
of our Bloomberg
Who do you
platforms.
expect?
Television, radio, our partnership with YouTube. Carol, these boxes pop up for our TV viewers. I never knew who's going to
Like,
be on
surprise!
it. I mean, I'm here every day, but you two, I don't know.
You're not here
You know.
every day.
I mean, I feel like one day Mike Bloomberg's just going to pop up on there.
I hope so. That would be a lot of fun.
That would be a fun conversation.
I would totally love that. Hey, we might get
What's
another.
he investing in right now?
I don't know. Let's ask him. You want? Come on, let's go.
No, I don't want to get in trouble.
All right, so S&P 500, we are looking at, well, we're right now below 7,800. We were thinking we could see our first close on the S&P above 7,800. We'll see if we get there, but right now, it's still going to be a record, right?
Yes, Carol Massar.
Well, hey, come on.
I'm just seeing if you're, awake over there.
We got a minute to go. We got a minute to go, Isabel. You know, I should note we're not even halfway through the month. We're already up over 4% on the S&P 500
for this month.
For this month alone.
Yeah. Well, we're only halfway through the month, or
You don't
barely
care?
through it,
Romaine
as you
doesn't
said.
Sounds so
Why
bored.
do you
Come
not
on,
care?
Isabel, help us out here.
Yeah, Isabel, help me out here.
We got data this morning again, and it showed inflation moderating, and I feel like investors are breathing a sign of relief, but we still have one more to monitor before the Fed meeting, so we can't be too complacent, I would say.
All right. Well, we did get those two benign inflation reports, and at least for right now, that combined with earnings, giving investors a little bit of a window to move a little bit forward here with this bull market, a bull market that continues apace, a bull market that, at least for the broad market, is going to end the day at a record high. The S&P 500 looks like it's going to close right around that 7,800 level. It takes a while for these numbers to settle, but it looks like it'll be a tick or two below that. Doesn't matter. That's still a record high, up 50 points or 0.7% on the day. The Dow adding about 70 points or about 0.1% on the day. The NASDAQ composite up about 0.8%. The NASDAQ 100 up about 1%. And the Russell 2000, just double check this. I believe it is a record high for the Russell 2000 as well, adding about 0.2% here on the day.
Wait, do you know? Are you confirming it?
I'm 100% telling you the Russell 2000,
Okay.
Carol Massar,
I'm just checking.
closed at a record high.
You got this incredible machine in front of you that tells
Yeah.
you everything. All right, let's go to the S&P. All right, so Russell at a record. You've got the S&P at a record. I'm going to go back to the S&P 500 because you did have most names higher, Isabel, in today's session, about 319 to the upside, 183 lower this Thursday, and you had one unchanged.
Let's take a look at the IMAP, Carol. So it's mostly green on the screen. Biggest gainers, of course, tech higher by nearly 1.5%. Communication services also in the green by 0.4%. You see some peppers of red there. I guess I'm wearing red. Energy is down 0.2%, and materials also lower by 1.5%.
All right, well, speaking of materials, let's take a look at Applied Materials, the maker of equipment to make semiconductors, out with its fiscal third quarter report. Sales, at least for its semiconductor business, did beat estimates at about $7 billion. Net sales, the total amount of sales for the company as a whole, 9.21 in the quarter. That's a slight beat over the average of street estimates. They were looking for about $9 billion. EPS in the quarter, a slight beat, $3.50. The street was looking for $3.42. But I can tell you right now, we need to dive a little bit deeper because what everyone wants to know is what that fiscal fourth quarter forecast looks like, whether this phenomenal growth we've seen for this company can actually continue.
Well, I will say Gary Dickerson, the company's president and CEO, says that he's further raising our semiconductor systems revenue expectations for calendar 2026. They're confident that they'll grow faster than the market this year based on the increased demand visibility we are receiving from our customers. We expect another strong growth year for Applied Materials in 2027.
All right, so I'm not quite sure. Forgive me, Romaine, if you already said this, but AMAT does see fourth quarter net sales of $9.75 billion to $10.75 billion. This gets to Outlook. The estimate on the street is $9.62 billion. Interesting to see the stock. It is down about 4.6% in the aftermarket. Keep in mind, it's up more than 100% year to date, Isabel. So it's just a little bit of perspective, but we'll look for some more headlines here to cross.
I think it's, again, expectation versus reality, and maybe investors are just expecting more and more. You have the CFO saying that this is the 13th consecutive quarter of year-over-year gross margin expansion. So that is a lot. That's 13.
I just want to go back to that number, though, because that fourth quarter number, and I think you kind of understand, the idea here also is everyone's looking at that percentage growth number and whether that's actually coming down, and it does appear, I need to do the math, but when you look at that range of 9.75 to 10.75, and this idea here of a company that had been enjoying some pretty healthy double-digit growth, and the idea that that's always going to be hard to sustain into the new fiscal year. If this is the fourth quarter number, I guess my big question is, what does the number for the full year up ahead actually start to look like? That's not in the release. I'm sure they'll be asked about it on the conference call.
Yeah, no, absolutely. And again, the stock not as low as it was, pairing some of the earlier loss, but still down about 2 1/3%, almost 3% here. So, yep, a lot of questions here.
There's also going to be questions, I think, too, about CapEx and what the company's going to spend on investing. The company's Senior Vice President and CFO, Bryce Hill, saying that they're making additional manufacturing capacity investments to support projected demand through the end of the decade. So that's up through the end of the next few years, right? More than 3 years out. They're saying continued strong revenue growth in the second half of the calendar year, particularly in DRAM, as well as leading edge foundry logic and advanced packaging.
All right, so we're going to keep an eye on this, look for a little bit more in terms of headlines and obviously the analyst call. But again, the stock we've seen a little bit under pressure. Hey, I'm going to go to some of the gainers in today's session. Here's one group, Sandisk, Western Digital, Micron, Seagate Technology. These were top in the S&P 500, the NASDAQ 100. Sandisk alone was up 13.7%. You've got Western Digital up more than 7%. You've got Micron up more than 4%, and Seagate Technology up almost 5%. You did have Sandisk come out, the computer hardware and storage company jumping to a session high, might even be a close high, but I have to check on that, after it announced its financial model for the years 2028 through 2030 at its 2026 Investor Day. Sandisk targeting the following as part of its outlook: revenue growth in the mid to high teens during that period, sees non-GAAP gross margins at about 80%, targets non-GAAP operating margin of about 75%. It goes on and on, but nonetheless, the whole sector we saw higher. I got to mention Workday as well. Shares jumping intraday high of about 30% after a Reuters report that private equity firm Silver Lake is in talks to purchase the software provider. So again, we saw this one moving dramatically. And then I'm just going to throw in Birkenstocks, just something different, rallying after the footwear maker boosted its adjusted EBITDA forecast for the full year. And so we did see that one also up just shy of 12% in today's session.
Okay, let's go to some of the decliners on the day today. Cisco Systems shares down 8.4%. The biggest decline going back to earlier this year. Ticker CSCO. This after the company projected $7.5 billion in AI data center sales this fiscal year. That disappointed investors. We talked to Woo Jin Ho from Bloomberg Intelligence a little earlier. He said for him, he didn't think it was the AI data center sales outlook. He said it was more weakness in the company's product, in the product gross margin. But nonetheless, Cisco shares did fall today by 8.4%. I also want to talk a little about Hertz. Hertz shares just getting crushed today, down more than 16%. This after Pershing Square's chief investment officer said the firm has sold its stake in Hertz. Pershing lost confidence in Hertz's management after the firm announced a funding plan that, quote, we did not think was necessary. This is Ryan Israel over at Pershing Square saying that. The stock drop snaps a run-up for the last six sessions after Wednesday's close. Hertz's stocks has seen some wild swings over the course of 2026. So some movement there, down 16%. And finally, let's talk ticketing and StubHub. StubHub shares falling after the company said earnings per share for the second quarter missed the average analyst estimate. The challenge here, Romain, was with the World Cup. The company's forecast for the full year underwhelmed, but I guess they had a lot of ticketing challenges for the World Cup, and people weren't able to get access to tickets that they somehow bought months in advance. And StubHub says it was an issue with FIFA, and now there are a lot of customers complaining about this.
Yeah, I remember seeing all that online. I mean, who's to blame? Who knows? But obviously StubHub taking the blame, at least based on the reaction in the shares today. A quick look at yields. They are down across the board here, down about 4 basis points on the long end, 5 basis points on the short end. That benign PPI report following a benign CPI report, giving investors a little bit of hope here for a bit more of a bond rally. But keep in mind, we also had that 30-year auction today where the Treasury had to pay up its highest yield on a 30-year auction since 2001.
And I just want to clarify, Sandisk not at a record high. That was back on June 25th when it was more than $22,335. I know. I knew you would come at me if I didn't mention something.
Yeah, I was going to correct you later.
I do like to, as you like to do. Hey, here's a story that's on our radar. It's among the most read on the Bloomberg terminal. Manhattan rents hitting $5,000. That is a record, while listings all but vanish. What was the story yesterday? Was it people paying $4,000 to get a peek on listings?
Because of the broker fee
issues,
right?
Yeah.
So, I mean, it's so competitive out there. It comes against, I mean, this is the way it works, Isabel. It's supply and demand, right? So a drop of supply, listing inventory in Manhattan plunged more than 39% year over year in July. Inventory in Brooklyn fell by 27% compared to last year. It is expensive out there.
I have a lot of thoughts. We moved to Brooklyn and then
welcome. Brooklyn. We are happy to have you.
I'm a Brooklyn girly now. So we were looking at an apartment and then we offered $100 above asking and we were beat by someone who offered $700 asking. So,
$100?
Yes, but we were beat by someone $700 a month, Romaine.
Per month, Romaine.
Yes, per month, Romaine. Maybe you and I are in a different tax bracket.
No comment.
Yeah, maybe that pied-à-terre tax is going to bother you.
Yeah, are we going to talk about that?
That's
Can we talk about something I can relate to? What is this pied-à-terre tax thing? Apparently it's back on.
Yeah, well, an appellate court.
What's the mayor doing? Come on.
Yeah, appeals court said it's on, so.
All right.
Yeah, get your checkbook out, Romaine.
Well, no, actually, I'm putting it away. Yeah, I had to write a check the other day for like the first time. I was like looking through the last time I actually wrote a paper check.
Oh.
Who are these people?
Okay, we got to run.
Like
we have
fintech
something
folks.
important to do on this side.
Tokenization, something.
Why not? Put it in the blockchain.
I got a cramp just right.
Thank you very much. That does it for our cross-platform. Thank you, guys. Appreciate it. Radio, TV, YouTube, Bloomberg Originals. Isabel and Romaine continuing on the close on the TV side. And, of course, Tim and I back here on Bloomberg Business Week Daily on Bloomberg Radio. Folks, we'll see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television. We'll be back in a moment. A bit of more of a breakdown on those results out of Applied Materials. Mehdi Hosseini joining us after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. 12 minutes removed from those closing bells and record highs for the large cap benchmark and the small cap benchmark as well. The Russell 2000 closing up about 0.2% on the day. The S&P up about 6 to 0.7% on the day, both at record highs. A little bit of relief coming from the oil space, from the energy space, from the metal space, and also the yield space as well. Your 30-year yield down in the secondary market by about 4 basis points. As far as some of the individual stories out there, a tale of two cities in the retail and fashion space. Birkenstock shares having a phenomenal day, up about 12% as that company gave a relatively bullish outlook, 15% growth going forward. Tapestry also gave a pretty good outlook, relatively bullish, but some concerns about some sequential declines in that growth rate, sending those shares down for their worst day in about a year. Meanwhile, a tale of two cities in the chip space. Cerebras, which reported yesterday, also gave a relatively decent forecast. Unfortunately, it was a forecast that still underwhelmed all of those high expectations out there. And Sandisk, how about that? Up 14% on the day. That company having its investor day here in New York and saying that it could sustain revenue growth in the mid-teens through at least 2030. It says gross margin could sustain itself at about 80%. And that brings us to our top story, which is yet again the AI trade. Applied Materials, another picks and shovels player out there, supplying those highly specialized machines and servers that semiconductor factories actually use to build a lot of those chips and GPUs. Remember, that stock, it had doubled year to date, though it had also been a stock that had gotten caught up in a big way in July's market degrossing of leverage AI trades. The revenue growth for AMAT, it is there. That is undeniable. And so too is the margin expansion. But the question right now is whether the company's AI-driven equipment boom is still accelerating into 2027 and beyond, or whether fiscal 2026 is going to be the peak year for growth. That means the fiscal third quarter numbers that we just got, which did beat, a little bit less important than the fiscal Q4 revenue guide that it just provided. That Q4 number coming in, well, I guess so far, pretty much in line with estimates. The question is that going to be enough to show strong sequential increases in growth heading into the next year that would show spending by TSMC, Samsung, SK Hynix, Micron, all those chip makers, whether that is still structurally ramping up rather than maybe just, well, producing yet another short-lived chip cycle. Let's talk about those earnings out of AMAT. Mehdi Hosseini joins us right now, Senior Equity Research Analyst over at Susquehanna. Mehdi, did you have a chance to look at these numbers? I mean, they didn't look bad. You see kind of a little bit of a down reaction in the market, though, in the after-hours trade.
Yes, and there isn't really much into it. The earning conference call will start in 20 minutes. But the reaction to the stock is very similar to what happened to the peer group back in July. I think there are two things that are playing out here. First, when you think about who is actually spending, the memory guys are upgrading. The capacity expansion part of the memory cycle starts next year. And in that context, memory spend would accelerate and Applied Material would benefit. And the second factor here is when you look at the entire AI supply chain, everybody is trying to rationalize higher margins. Memory manufacturers are operating around 80%, TSMC is near 60%, and Applied Material and the peer group are also trying to raise prices. And in that context, it will take some time to justify, rationalize higher prices, and this is where you see the upside is more on the margin for Applied Material, not so much on the top line.
Well, this gets to the idea, and we should point out in the release, they're only giving that fiscal 4Q number. Obviously, most investors are looking a lot further out than that. If you listen to what we heard from Sandisk today, and even what we heard from some of the companies that actually reported earnings over the last couple of weeks in the chip space, it seems that most of these CEOs think that the memory crunch, the chip crunch overall, component crunch, maybe we should just say, is actually going to be lasting for another couple of years, at least another 18 months. Is that kind of your view as well?
Absolutely. It's just that the pace of spending that it's makes it kind of volatile. And as I said earlier, the capacity part of the memory spending is yet to play out. That's more of a next year. And back to your point, I think investment will accelerate into next year. And this is something that I'm looking forward to get more detailed color from Applied Materials earning conference call. But definitely spending is going to accelerate.
As that spending accelerates, I am curious just about the competitive advantages that AMAT has. Obviously, it's a very specialized player, not quite the same as what ASML and some of those others do. I guess it competes more directly with Lam Research and a few other companies like that. Does it have a true competitive advantage over some of those folks?
Yes, it's a duopoly for certain part of manufacturing. You can argue that China is becoming a bigger competitor. Applied Materials competitors in China on aggregate accounted for only 5% of the equipment industry a couple of years ago. And into next year, they would account for 15 to 20%. But the size of the pie is also increasing. And even though Chinese competitors have become stronger, spending is accelerating. So the competitive landscape is not really an issue. All of these companies claim to have 100% market share, but I think overall market share is going sideways. It's just an acceleration in the spend, and where numbers would go for next year is something that investors would need an update from an earnings conference call.
So when we talk about what you want to hear on that conference call and the idea of the long-term business model here, is there something that you think they could tell you that would give you a little bit more comfort in not only standing by longer-term forecasts, but the China risk, the export control risk, and also just the general idea of preserving margins and margin quality?
I think the China policy and the China risk is something that I've been dealing for a decade. It's nothing new, and it's going to be the same. And I'm not sure if I'm an expert here, but I've been dealing with this for a decade, and it's not a factor. I think what I like for Applied Material to elaborate is how spending would evolve. You have a memory spend. Within memory, there are segments. In the logic, you have foundry. There's actually a diversification of spending in the foundry space. Intel and Samsung are catching up. I wish Applied Material would elaborate. They have, over the past couple of years, been very sensitive to their customers. They have been reluctant to share information. All of these companies stopped providing booking and backlog. This is something that industry has to rethink, but I think they will provide some qualitative assessment. I'm not sure if that's going to be enough. I think at this point, investors just have increased confidence that investing by Applied Materials customers would accelerate, and that's what I think. And I think it is more of a next earning conference call that they will be able to provide details. This conference call, I think, is going to be more qualitative. I'm not sure if investors will be pleased by it.
All right, Mehdi, always appreciate it. Mehdi Hosseini, Senior Equity Research Analyst at Susquehanna International Group. That conference call kicking off in about 20 minutes' time, with the shares now on AMAT down about 2 to 3% in the after-hours trade. All right, coming up here, we're actually just wrapping up the big restaurant earnings season. We had Jack in the Box and Brinker overnight. Earlier in the week, we heard from Cava and a few others. A lot of concerns, not so much just about the traditional metrics, but how all these companies are dealing with some of the concerns about the outbreak of Cyclospora Cyclospora and Salmonella. We're going to catch up with Nick Setyan over at Mizuho when we come back after the break. This is Bloomberg.
I think it's a little bit of a misconception with the name of Sweetgreen that it only sells fresh raw produce. While we're great at fresh raw produce, we also serve a lot of delicious cooked food.
Sweetgreen CEO Jonathan Neiman speaking with us on the program yesterday, downplaying the chain's greenness, if you will, as of course consumers right now hyper-focused on this Cyclospora outbreak that is directly tied to lettuce overall. Not necessarily lettuce at Sweetgreen, but those shares still down more than 30% over the last 30 days. And of course, other restaurant stocks have also gotten hit because of broader fears out there about how exactly this has been contained. Nick Setyan is managing director over at Mizuho, and he covers the restaurant sector for us. And it was kind of an interesting week because in the midst of all this Cyclospora outbreak, we were also getting earnings out of these companies. I am curious just overall, because based on what we heard, with maybe the exception of Sweetgreen, the vast majority of them seem to suggest that the impact on their foot traffic, either in the past quarter or in the week since the quarter ended, is minimal, if not non-existent.
Well, it's a pleasure to be on, Bostic. The impact early on was, especially for fast casual, which is what segment Sweetgreen plays in, was high single digits in terms of negative traffic. Even Kava mentioned it. But since then, it has improved exiting July and into August, where Kava's comps are now back up to mid-single digits. And so across the board, we saw a big impact early on, but the impact has waned to, I'd be surprised if by September, we're still talking about an impact continuing.
I mean, we saw that with Taco Bell. They saw traffic down something like 30% or so in the basically right on the heels of the public being made aware of the Cyclospora outbreak. But they were also pretty confident that that was a temporary dip.
That's right. Yeah, and it was down 30. July is probably going to be down 20% or so. And it's going to continue to improve from there. But they were the direct impact there. And so if anyone's going to be impacted, it's going to be Taco Bell. But even there, I think the impact's waning.
It's waning. And it gets to this idea. I mean, you have the fast food companies like Taco Bell. And obviously they got hit because the reports were that the Taylor Farm product that was at Suspect was directly in their supply chain. Not necessarily with Sweetgreen, but again, they're a salad chain. I mean, despite what the CEO says, that's what most people perceive them. But then I think about Kava, which seemed to suggest, okay, our same-store sales growth is still going to be what we said it was going to be prior to this outbreak. And I know that, they have a lot of warm bowls, if you will, but it's still traffic's in fresh produce.
Right, and Kava and Chipotle and Panera, et cetera. I mean, across the board, we did see an impact, and not just Taco Bell and QSR, but, McDonald's, et cetera. And the impact was concentrated. It was concentrated in the Midwest and to a lesser extent in the Northeast, where a lot of the news was higher, relative to maybe the West Coast. But again, I mean, across the board, that impact has waned now.
What about the sort of sit-down chains out there? We heard from Brinker, the owner of Chili's, I think it was yesterday or the day before. We got earnings already out of Dine Brands and Cheesecake Factory and some of the others. Was there no real material impact in any of those companies?
No material impact in any of those companies. If anything, they may have actually seen a little bit of a benefit. I mean, their trends have accelerated exiting Q2 with July all the way through August, accelerated quite dramatically, the traffic trends. So there may have actually been a little bit of a shift from diners going to fast casual and QSR to casual dining. But, the acceleration in casual dining even preceded the outbreak. So no impact at all.
And just real quickly, I only have about 30 seconds left, Nick. With regards to just the health of these companies prior to the outbreak, was there some sense here that most of these companies were kind of on the upswing, or were they still dealing with issues with the consumer?
QSR continues to deal with that lower income consumer. Fast casual was on the upswing, particularly Chipotle. They had a very good quarter, very solid commentary. it may have been derailed in the short term, but like I said, I think that impact's going to be short-lived. No impact casual dining.
All right, Nick Setyan over at Mizuho. When we come back, we're going to talk insurance. This is Bloomberg. Wall Street is looking for new ways to keep the private markets moving as firms aim to return cash to clients on long-term investments and, of course, increase their own liquidity. Our next guest is someone with deep experience in that space. Anant Bhalla is the CEO of 1823 Partners, which has about $19 billion in assets under management, but he's also the chief investment officer and global head of insurance over at JAB Holdings, a $70 billion family office that is focusing on a portfolio of consumer and life insurance businesses. Anant, great to have you here.
Thank you. Thanks for having me.
When most people think of JAB, they tend to think, of course, of consumer products. About 25% of their portfolio right now is insurance, and you are the pillar of what seems to be their effort to build that out. Why?
It's very simple. Consumer businesses do very well when interest rates are low, and insurance businesses do very well when the scenario is inverted. So there's a direct correlation between the diversification benefit between consumer businesses and insurance businesses.
So let's talk about this mashup. I mean, we didn't have it there in the top, but a lot of people know you from American Equity, from AEL, and what was a pretty novel concept back at the time. And of course, now we see everybody trying to do that. Obviously, Apollo with Athene and quite a few other of the other alternative asset managers, if they haven't either bought or partnered with an insurance provider, they're certainly looking to. What is the difference between what you're doing at JAB and maybe what we're seeing with, say, like an Apollo Athene, for example, not to pitch you guys against each other?
No, everyone's got a different approach to this. Our approach is we bring permanent capital that thinks for decades, that can take a very long-term horizon. Private equity, the alt management space, is very good at what they do, but they have one flaw: time. They run out of time. They invest for a finite period of time. When you have permanent capital, you look at multiples of invested capital. So you take the benefits of IRR, multiply that by duration. We're long duration investors.
Give me some sense of the structure. We introduced you with 1823 Capital. So my general understanding is you're taking the annuities that you're getting from the insurance business at JAB. 1823 is investing that money. Is that the idea?
That is correct.
Okay, and then that feeds back into the JAB insurance business.
Yes, so 1823 has an anchor investor. It's JAB Holdings through its insurance business and the holding company as well, as we may look at different opportunities beyond consumer. And that has allowed us to build 1823 around three pillars. The first pillar is advice, risk management for pension funds, for insurance companies, with JAB being the anchor investor, as I mentioned there. The second pillar is really around credit products that are more around asset-backed lending, looking at collateral, going through the fundamentals of credit work over a long period of time. And this time it's different. To quote a very famous book, really not so. It's not very different. Credit goes through cycles. We're in a very long cycle. And the third is owning permanent businesses, a way of owning companies that can go private without having to be on the private equity clock.
You've said in the past, I've heard you talk about that kind of the future of insurance is permanent capital. There are some people that look at the private asset space right now and say there's a lot of risk associated with that wouldn't necessarily have been associated with traditional, government bonds, investment-grade bonds that insurers would traditionally traffic in at a high degree. What is the risk-adjusted sort of proposition there for being more invested in alternatives rather than into bonds?
I'm glad you asked me the question. You always have to look at return per unit of risk. And the entry of alt managers into the insurance space has resulted in underwriting illiquidity and underwriting complexity. So when you look at those return in private markets, private markets is a $40 trillion market. It's a very big market. There is leveraged finance, which is one part of the market. There's asset-backed lending. There's middle market sponsored lending. We're relatively negative on sponsor lending in the middle market. Why? Because the world doesn't need another manager jumping in. That's why we didn't jump in there. But when you look at working capital finance, you look at supply chain finance, anything that's asset-backed, that's collateralized, that can be structured well. So you really have to look at 4 S's. How do you source? More and more companies are private. There aren't that many public companies out there. And frankly, investment-grade credit is where you're buying unsecured assets right now. Right? So we are negative on investment-grade corporates as well. Where we are positive is on good quality collateral that can be structured, that can be bought at the right price, and then you're focused on the downside. You're looking at the downside scenarios, not just hoping for upside. Insurance is about managing convexity of risk.
Mm-hmm. It is. Are your investment practices, more importantly, your sourcing and underwriting practices on the investment side, does that match up with what I would assume is the relatively conservative underwriting standards that the insurance business would have?
What has happened is, with the entry of alt managers in this space, the cost of funding, the cost of those liabilities, that insurance funding has gone up 100, 150 basis points over the last decade and a half. So now you can't only invest in boring public fixed income. Mm-hmm. You have to invest in pockets of private markets, but where you get those 4 S's right. You source them, you structure them, you're doing surveillance on them, and then you're syndicating the risk out for price validation. I think a big risk in this market is there is no price validation unless you syndicate to others, and there are other buyers of the risk. Everyone can love their own risk, but until someone buys your risk at the same price that you bought it, there's no validation.
I want to talk about some of your acquisitions or pending acquisitions at most. What's happening? That was supposed to close in the first half of this year?
We're working towards that. Yeah. Yes, our plan was to close in the second half of the year.
Second half, excuse me, sorry.
No, not at all. Yeah. And we're looking forward to closing that transaction fairly shortly in the coming quarter.
And what about Colombian? Is that still,
that is pretty imminent. That is an imminent.
Imminent. You're just waiting on the regulators to get that done. So, with regards to what you would be interested in buying going forward, well, first of all, would you actually buy outright public life insurer?
Probably not.
No.
I think we've got a really good platform right now. We've got Prosperity in the U.S. focused on the retail market where we've focused its energies. We think there's a retirement crisis in America, a real retirement crisis in America that's growing, and there needs to be a solution. The Trump administration's talked about things like the Australia model, which we are highly supportive of. In addition to that, the pension business in the U.K. is very interesting to us. And then we are an insurer for other insurers through reinsurance. That's how we will grow. We're bringing on a team very shortly that's going to be building out our reinsurance practice because we have the capital and the wherewithal with that permanent capital to be a backstop to public insurers. Insurance is a business that should not be very public. It should be in permanent hands.
What about a private credit arm? I think about Apollo, and they have a third-party private credit arm. Is that something that you're considering? Do you need it?
So we have pockets of private credit that we like, that we've built within 1823 Partners. 1823 specializes in real estate, for example, across the board. We're a go-anywhere firm. Invest in credit, invest in equity, in real estate. Thematically, there are other part of the sectors we like, as I mentioned, supply chain. So we will do private credit, but not sponsor-backed private credit directly. We're sidestepping that part of the market because we think it's picked over.
When you say supply chain, what are we talking about?
We're talking about
transportation or what?
We're talking about, for example, take the AI boom right now.
Okay.
There are parts of the AI boom which are a binary risk. We don't underwrite binary risk. You know, we have to return capital back to policyholders or family offices over time. But what we can do is the chipsets that are going into that, they need an off-balance sheet financing. The structures around that, how to structure that in a manner that it's not winner take all, that you're off the risk before it really bears out. That's how we do supply chain.
With regard to the AI infrastructure build out, there are insurers that are playing in this space. Some probably have to just because that's what their clients want. But is there an insurable business model, if you will, for the AI infrastructure build out, or is it just fraught with that potential risk?
Taking binary risk, like development risk is binary risk. You can have winner takes all in this market. And a scenario where a hyperscaler can pick winners and losers is not something we want to underwrite. What we want to underwrite is where we have certainty to cash flow and we're off the risk. We're looking at how quickly we can get out of the risk position, not be stuck with it.
I do have to ask you about AEL. I mean, you built that up, you sold it to Brookfield. And now I see you kind of doing this again with a JB. Obviously a little bit different because it's a family office, so it's a little bit different. But it raises a lot of questions as to whether sort of this mashup between alt managers and insurers, whether that's to kind of reach some degree of maturity. I mean, how much life is left in this sort of model, or have we just seen the best of what this has to offer?
The model which is fee-driven, focused on bigger is better, doesn't work, in my humble view. The model where you say I'm going to compound returns And this is a stable form of financing along with permanent capital, the equity being the insurance company from a vehicle like JB or family office investors. That model has a lot of legs to go. Why? Because you've got an alignment between the promise, which may be a 10, 20, 30-year promise, and the capital, which is 30-year capital. Alt managers don't have 30-year capital. Public markets don't have 30-year patience or 40-year patience. I think that model is the life insurance 3.0.
All right, Anant, this is a fascinating conversation. We had to get you back, talk a little bit more about it as you continue to build. Anant Bhalla, Chief Investment Officer over at JEB Holdings and the CEO over at 1823 Partners. Just wanted to bring to your attention here a redhead crossing the wire. This on the U.S. Credit rating over at Fitch being affirmed at AA+. That just now crossing the Bloomberg terminal. We're going to take a quick break here and reset here. You take a quick look at what's happening in the post-market trade as that conference call with Applied Materials now underway, coming off of a record day today for the S&P and the Russell 2000. This is The Close on Bloomberg. IPOs in the consumer space picking up, particularly after the trading debuts that we saw of Jersey Mike's and Reformation just a few weeks ago. So what could actually be the next big brand to go public? VMG Partners. It's investing in companies like Spindrift, Kind Bar, Solidcore, Ancient Nutrition, Little Freddy, a lot of few others. The firm, a lot of products, it says, are better for you consumer brands, and that those can remain resilient in the public and in the private markets. Robin Tsai joins us right now. He is the managing partner over at VMG. Great to have you here, man. When I look at your lineup of brands and, vast majority of these we've seen on the shelves at some point or another, but I was always told that venture wasn't really interested in a lot of these consumer brands, that it was hard to really value them. It was hard to really take that risk of making sure that what might seem like a good idea can truly scale in what we know is just this hyper-competitive environment for store shelves.
I think that's true. Thank you for having me. I think all of that's true. The one thing that I will say is that the way that we actually invest in consumer is decidedly different. We're not necessarily venture. We're looking at businesses that already have revenue. Oftentimes these businesses have a good amount of scale, they're profitable, and more than anything else, there is a consumer that's very, very passionate about that particular brand. And so what may end up looking like something that is sort of the dark arts of just picking good brands, it actually ends up being quite quantitative. There's a lot of data that we're able to get, both in terms of sell-through, in terms of sort of the company's financial health, consumer sentiment, what's going on in social media. There are a lot of sort of data points that all sort of point us in the right direction, and that really affirms our belief in particular businesses that we support.
Well, give me a sense as to kind of what you're talking about with regards to those data points. I mean, obviously, I know it's just, obviously demand, but I assume you're trying to tap into certain trends as well that I would presume, think are going to be sustainable.
Absolutely. And it really is a consistent theme that we've actually seen over these past 20 years, which really is consumers are more and more focused on investing in themselves. And sort of this category or this pocket of investing that we've really focused on it's really more focused on modern staples. And while an economist might not think of them as staples, it is, as you kind of think about it, it's sort of the things that you put in your body, on your body, and that are around your body. And these are things that you want to invest behind. It could be, you had mentioned before, Kind Bars or Spindrift, which is a sort of a sparkling water that's just honestly better for you. It could be Solidcore, which is a Pilates concept, and so on and so forth. People are willing to actually go and pay a little bit extra when it comes to investing in their families and in their own health.
Right. And also, I mean, we talk about the body as well. I used to have an old colleague who used to always joke, invest in your face. And I saw you bought Vacation sunscreen brand. And she was serious, believe it or not. You paid $70 million for that. We had the Supergroup founder on a couple of weeks ago, speaking of sunscreen. But when I think $70 million for a sunscreen brand, I mean, what does that actually tell us about kind of what a breakout consumer brand can really be and be really worth?
Yeah, I think that what ends up happening is there's a good amount of pattern recognition. Vacation was a deal that we invested in, but what really sort of presaged that was we were investors in another brand called Sunbum. I don't know if you're familiar with that one. It's the big monkey. And that was really built off of a lot of, I think, tongue-in-cheek humor. There was a lot of surf skate sort of endorsement in that business as well. But we always knew that this consumer these days, they are worried about sun protection. That is something that is really pervasive. Again, it could be for yourself. Oftentimes it's for your kids, but you're just trying to do better. And ultimately, for Sunbum, for example, we held that a couple of years ago. We sold that business to SC Johnson. And so, again, most of the time, the businesses, especially the product-oriented brands that we're investing in, we're building them for strategic exit. And that's really our primary area of focus.
Well, let's talk about strategic exits. I mean, obviously, the idea is to sell to a Mondelez or Nestle or PepsiCo or whoever, General Mills. But also those companies now, they're all running their own venture arm. So I kind of wonder, is that your exit or are they your competitors?
That's a good question. Honestly, it ends up being a pretty symbiotic relationship. What ends up happening is, and we've seen this kind of go in waves, most of the time when you've got a great entrepreneur or founder, they're putting something into the world that they feel like it's either a great business idea or they're trying to solve their own personal need. And it's usually not something that's hyper engineered for exit. I think for us, that's really where we come in. We see that there is great product market fit. We see that there is a real interest from a strategic perspective on, hey, we just don't have something that sort of fits within this, this part of our portfolio of products or services. And then we start to actually build backwards. We build these businesses specifically for strategics. I would say the venturing arms are helpful because I think they are honestly oftentimes a conduit to sort of letting these strategics know what's up and coming. Mm-hmm. Sometimes they're involved with the businesses that we invest in. Sometimes they're not. But more than anything else, what they're doing is they're educating the larger strategics on what's up and coming, what's about to actually hit next.
Obviously, the strategic side, sale is obviously a big exit strategy. What about IPOs? Is there demand? I mean, I mentioned a couple of food IPOs. That's a little bit outside the realm of what you do when we talk about, say, a Jersey Mike's. But I am curious as to whether there is appetite in the IPO market for just consumer brands overall.
Yeah, I mean, we keep an eye on it. Obviously, you mentioned a couple that are happening this year. The truth of the matter is, in terms of just the number of IPOs, they aren't going to be as high as in some other categories. Where we spend more of our time, truthfully, is in more of sort of the M&A market. So it is a much more of a focus on what a strategic's looking for, what a larger sponsor's looking for as well.
I do want to ask about just kind of what you're seeing overall. We talk a lot on this show about consumer trends, and you mentioned data, obviously you being in the selection process for what you invest in, but I assume you got to be sitting on a lot of sort of like scanner level data across, food and beverage, beauty products, et cetera. I mean, what are you seeing right now when it comes to just buying patterns? Is there stress out there? Are people still just willing to spend, able to spend?
It's a great question. I think a lot's been made about the K-shaped economy. That absolutely is true. But you actually do find that there's always been a big disconnect between consumer sentiment and consumer spend. And at our shop, we always talk about following the consumer, and ultimately, it's really where they want to put their money. And in this sort of better for you segment, I mean, that is an area that they're willing to spend in. It's easier to convince themselves that they're doing something good for themselves or their families. So we haven't seen a slowdown in those categories. I could see bigger ticket items, maybe luxury items, things that are truly more sort of one-time purchases in nature. At some point, maybe there's going to be a little bit more of a slowdown there. I think, there's been a lot that's been made out in what's going on in luxury. But more of sort of the better for you, that wellness, food and beverage, beauty, personal care, the pet space. These are the areas that we concentrate in, and these have actually performed incredibly well.
Are you seeing more interest in this space, particularly given a lot of the concerns about AI, sort of, eating the lunch of whether, software business or other types of technology business, and this idea, certainly you're seeing in the private equity and private credit space, this idea of like, we want anything but AI, we want to buy, a pest control or a pet company or, a maker of salt. Are you seeing that kind of stuff right now?
We are actually. Yeah. It's interesting. It's an odd conversation sitting here in San Francisco, but it's not that we've changed thesis. That's not the idea. But at the end of the day, people are still going to eat chips. They're still going to want to work out. These are tangible, real-time things that they're actually going to be partaking in. And so that's very, very difficult to disintermediate. I think that technology is absolutely important to us, but more as customers, truthfully. Like, this is a great time for us to assess what type of software we're using. Can AI actually make our businesses more efficient? One thing that we spend a lot of time thinking about is within the consumer space, consumer gross profit dollars, it's one of the largest gross profit pools across the US economy. But then when you get from gross profit to EBITDA, that leakage is actually quite high.
Yeah.
We do think that with AI, that's going to change. We think that the conversion from gross profit to actual EBITDA is going to improve dramatically. It's not going to happen overnight, but absolutely we want to be front-footed there.
All right, Robin, great to have you back on the program. Robin Tsai there, managing partner, general partner over at VMG Partners, a focus on the consumer. And as we go to break and we come back, we're going to focus in on what to watch over the next 24 hours. This is Bloomberg. Let's set you up for what markets will have their eyes on over the next 24 hours, and it starts at about 8:30 a.m. tomorrow with the retail sales report for July. There is some expectation of a bit of a moderation in some of those advanced month-to-month sales, but when you back out autos and gas, things look a little bit better. We're also going to get another read on the consumer at 10 a.m. with the University of Michigan sentiment numbers, which for a while had been oscillating in dour conditions, but improving as of late. And tomorrow is the deadline for those quarterly 13F filings, where we get to see exactly what the holdings were at the end of the quarter for all of those closely watched hedge funds. In fact, we're getting some crossing the wire right now, including from Baupost, who actually exited its Willis Towers Watson stake and boosted its stake in Amazon. We'll be back tomorrow here on The Close for all your political coverage. Stick around. The team at Balance of Power is up next after the break, right here on Bloomberg.